everyone. Welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of the book Common Stocks and Uncommon Profits by Philip A. Fisher. It has been created with the help of AI. You can read the original summary at samfury.com.
Hey investors, ready for some serious investing wisdom?
Yeah.
We're diving deep into Common Stocks and Uncommon Profits by the one and only Philip Fisher.
You know, this book's a classic for a reason.
Oh, absolutely. And we're going to uncover its hidden gems.
Just for you.
That's right.
Fascinating. Fisher wasn't just some ivory tower theorist.
Okay.
He built his philosophy over decades of real-world experience.
Yeah, I like that. Real-world experience.
He started investing in the Roaring 20s.
Oh, wow.
Talk about a trial by fire.
That's jumping into the deep end. So tell me more about this Fisher philosophy. What's the big idea?
Okay, imagine this.
Right.
You find a company that's not just good, but truly exceptional.
Okay.
It's got a killer product, rock-solid management team.
Yeah.
And it's poised to grow for years to come.
Okay.
Fisher says, don't just buy a few shares. Make it a cornerstone of your portfolio.
Okay.
And hold on tight. Let those returns compound over time.
That's the essence of his approach.
Exactly.
Okay, starting to see why they call him the father of growth investing. But how do you find these exceptional companies? It's not like...
Right. And that's where Fisher's famous 15 points come in.
Oh, okay.
Think of these as your treasure map, guiding you toward companies with uncommon potential.
Yeah.
We don't have time to go through all 15.
Yeah.
But let's dig into a few that might surprise you.
All right. I'm ready for some surprises.
Okay.
Hit me with those hidden gems.
All right. Most investors obsess over a company's latest earnings report.
Yeah.
But Fisher challenges us to look
beyond
the short-term noise.
Okay.
He's all about what he calls
what's that?
Long-range growth potential. It's not just about what's happening this quarter or even this year. It's about imagining where this company...
Where will they be?
...will be in 5, 10, even 20 years.
Wow, okay.
Can they keep innovating? Are they adaptable?
Yeah.
That's what separates the true winners from the flash-in-the-pan companies.
Okay, so we're thinking long game.
Yeah.
What else?
Here's one that might raise some eyebrows.
All right.
The power of...
Of what?
A strong marketing organization. You might think, okay, marketing is important for consumer products.
Yeah.
What about?
Yeah. What about?
Say, a boring industrial company.
Yeah, I'm not picturing flashy billboards for steel beams or something.
Exactly.
Yeah.
But Fisher's point is...
I'm listening.
...that even if a company makes the best steel beams in the world, if they can't effectively communicate their value, build relationships, and create a strong brand, they're going to miss out.
Miss out on opportunities.
Yeah. Think about it.
Okay.
Apple doesn't just make phones.
Right.
They create a whole ecosystem.
Yeah.
A brand experience. That's marketing.
Yeah.
Doing its job.
Yeah.
And that applies even in less glamorous industries.
Okay. I see the bigger picture. Marketing is about so much more than just advertising.
Right.
Okay. What else did he emphasize?
Another often overlooked point
is
the importance of research and development. And again, not just for tech companies. He uses the example of a food processing company that invests heavily in research to improve its packaging.
Okay.
Sounds pretty mundane.
Yeah, not exactly.
Yeah.
Stuff of Silicon Valley dreams.
But this seemingly minor detail actually gave them a huge competitive edge.
Okay.
Their packaging kept food fresher, longer, extended shelf life, and reduced waste.
I see.
That translated into happier customers, lower costs, and ultimately higher profits.
It's like those stories where like a tiny tweak in a manufacturing process leads to massive efficiency gains.
Yeah.
It's all about those hidden advantages.
Precisely.
Yeah. And don't forget financial skill.
Right. Yes.
This isn't just about crunching numbers, right?
No, no. It's about having a management team that understands the levers of the business. They can adapt to changing markets.
Yeah.
Manage resources efficiently.
Okay.
And make smart financial decisions.
That set them up
for long-term success.
All right. So we've got a company with long-term vision, a killer marketing strategy, a commitment to R&D and financially savvy leadership. I'm impressed already. But Fisher had another trick up his sleeve, right?
Yes, he did.
Tell me about this scuttlebutt method.
Scuttlebutt. Everyone talks about.
It's like being a financial detective.
Ooh.
Fisher believed in going beyond
the numbers.
the polished numbers in a company's annual report.
Okay.
And getting a real feel for the business.
So instead of just staring at a spreadsheet.
Yeah. He'd go out and talk to people.
Exactly. He talked to customers,
Wow.
suppliers, competitors, former employees.
Okay.
Anyone who could offer insights into the company's true strengths and weaknesses. He believed that those everyday conversations could reveal more than any financial statement.
That's like investigative journalism for investors. I love that.
It is.
Piecing together a narrative, a story about the company.
You got it. And this wasn't just about gathering gossip.
Okay.
It was about
Yeah.
forming your own informed opinion.
Independent of the market.
Independent of what the market was saying.
I like it. Okay, so we got our detective hats on.
Yeah.
We're gathering intel. We're starting to get a feel for some promising companies. How do we actually evaluate
That's a great
these
point.
potential investments? Enter the 4 dimensions of a conservative investment.
Yes. And don't let that word conservative throw you off.
Okay.
It's not about being risk averse.
It's about being a prudent investor who's thinking long term, looking for companies that can weather storms.
Makes sense.
Yeah.
So what's the first dimension we need to consider?
First and foremost, focus on the company's products or services.
Okay.
Are they high quality, in demand, and do they solve a real problem?
For the customer.
For customers.
Right.
And here's a key point.
What's that?
That Fisher emphasizes.
I'm all ears.
Does the company have a low-cost production advantage?
So it's not just about making a great product.
Right.
It's about making it efficiently.
Exactly. Think about it.
Right.
If you can produce goods or services more efficiently than your competitors, you have more flexibility. You can offer competitive prices, reinvest in growth, and even weather economic downturns better. It's a fundamental source of stability and reduced risk.
Okay, low-cost production advantage.
Yeah, check.
Check. What about dimension number 2?
Dimension 2 is all about the people running the show.
Okay.
The management team, are they skilled, experienced, ethical, and truly aligned with the long-term interests of shareholders? What kind of company culture have they created? Remember, a company's only as good as the people leading it.
It's like that saying,
right,
a fish rots from the head down.
Yeah.
You can have the best product in the world.
Right.
But if the leadership's weak,
right,
or the culture is toxic, it's going to be a risky investment. Strong leadership.
Yes.
Check. What's next?
Dimension 3 is about competitive advantage.
Okay.
What makes this company stand out from the crowd? What makes it hard for competitors to copy or displace them?
Right.
Does it have a strong brand, unique technology, patents, or something else? That gives it a durable edge in the market. So we're looking for that special sauce.
Okay, exactly.
That secret ingredient that makes them a long-term winner.
And this is where Fisher's emphasis on research and development
really comes into play.
Yeah. Companies that invest in innovation and constantly strive to improve are more likely to maintain that competitive edge.
3 down, 1 to go.
Okay.
What's the final dimension?
This is where it gets psychological.
Oh, okay.
The 4th dimension is about how the company is perceived
by investors.
Is it undervalued, overhyped?
Yeah.
Are investors missing the real story?
Okay.
This is where your independent research and critical thinking really come into play.
So it's not just about the company itself, but understanding how the market is valuing that company.
Right.
Are they getting it right?
Exactly.
Or are they missing something?
And this ties back to the idea of scuttlebutt. By talking to people, gathering information from multiple sources, you can form your own judgment. Independent of the market's sometimes fickle opinion.
Okay. That's fascinating. It's almost like you're trying to get a step ahead of the market to see things before everyone else does.
Yeah.
Okay, we've covered the 4 dimensions, but now I'm curious.
Okay.
When is the right time?
Yeah, when is the right time?
To buy or sell, according to Fisher. Is it all about timing the market?
Actually, Fisher had a very different approach to timing than what you might hear from day traders or market timers. He believed in buying when a great company is temporarily out of favor due to short-term factors.
Like what?
Maybe they missed an earnings target. Or there's some industry-specific news that spooked investors.
So it's about looking for those moments when a good company is on sale, so to speak, when the market's overreacting.
Exactly. And on the selling side, Fisher's very clear. You should only sell.
Only sell when?
If you made a mistake in your initial assessment. If the company's fundamentals have deteriorated. Or if you find a much better opportunity.
It sounds like patience is
absolutely.
a major virtue.
A major virtue.
In the Fisher philosophy. Hold on tight to those winners. Don't let the short-term noise shake you out of a good investment.
And that brings us to another interesting point that Fisher makes about dividends. A lot of investors are drawn to stocks with high dividend yields. But he has a slightly different perspective.
Oh, this is interesting. I'm all ears.
He doesn't dismiss dividends entirely. But he argues that reinvesting profits for growth is often more beneficial in the long run, especially if you're not relying on dividend income to live on.
So it's not just about how much dividend you're getting each quarter. It's about how that company is using its profits to grow and create even more value.
And he also emphasizes the importance of a consistent dividend policy rather than just a high yield. It's about finding companies that have a track record of sharing profits with shareholders in a sustainable way.
So we're thinking long-term growth, consistent dividends. Got it. Now, one last big idea before we wrap up this section. The efficient market hypothesis. This is the idea that all available information is already reflected in stock prices. So it's impossible to consistently beat the market. But I have a feeling Fisher wasn't buying that, was he?
Not at all. In fact, he strongly disagreed with the efficient market hypothesis. He believed that markets are not
perfectly efficient.
And that skilled investors who do their research can find opportunities to outperform.
So he believed that there are always inefficiencies, little pockets of opportunity where a savvy investor can find hidden gems.
Exactly. He believed that by doing your homework, thinking independently, and focusing on the long term, you could find companies that the market was undervaluing.
And to illustrate his point, he even shared some pretty compelling examples in his book.
Like what? Give us a taste.
Well, he talks about the story of the Raychem Corporation. This was a company
that was trading at what seemed like a very high price to earnings ratio. Most investors would have looked at that and said,
too expensive.
Nope, too expensive. But Fisher argued that it's strong fundamentals. Innovative culture and growth potential justified the price.
And guess what? He was right.
He was absolutely right. The company went on to deliver exceptional returns for investors who were willing to look beyond the surface and see the true value
that the market was missing.
This
is why I love diving into these classic investing books. There's so much wisdom to be gained from people who have seen it all and built successful track records over decades. They've lived through market crashes, bubbles, and everything in between. All right, so we've covered a ton of ground here, from the power of long-term thinking to the art of scuttlebutt to the 4 dimensions of a conservative investment. But we've only just scratched the surface of what Fisher has to offer.
And there's even more to uncover.
Absolutely. Let's keep exploring.
Okay.
I was thinking about that Reckman story. It wasn't all smooth sailing for them, was it?
No.
They hit some rough waters along the way. I remember reading about a major product failure they had. Not exactly a recipe for success.
That's right. In fact, Fisher talks about how they had to go through this painful restructuring process. Their stock took a hit.
Yeah.
A lot of investors. Probably jumped ship, thinking the good times were over.
Yeah, so what happened?
Well, did they bounce back?
That's what's so remarkable about Raychem. They didn't just bounce back.
Yeah.
They emerged even stronger.
Okay.
And this is where Fisher's insights about management and culture
really shine. Okay. I'm intrigued.
Yeah.
Tell me more. What did they do differently?
Instead of panicking and making rash decisions, they stuck to their core principles.
Okay.
They had this incredible culture of innovation.
Okay.
A willingness to learn from mistakes. And a management team that was deeply committed to the long-term vision.
Okay.
They didn't abandon ship just because
they hit a storm.
Weathered
it, came out stronger. It's like that saying, what doesn't kill you makes you stronger.
Right.
But in the business world, that's easier said than done.
Yeah.
A lot of companies crumble
Yeah.
when they face those kinds of challenges.
Exactly, and that's what Fish trying to get us to see.
Trying to get us to see those moments of crisis can actually reveal a company's true character.
Okay.
And it's something that a purely quantitative analysis might miss an algorithm, wouldn't have seen Raychem's resilience or its long-term potential.
Okay.
It would just looked at the numbers and said,
sell.
Sell.
Okay. That's a powerful example of how Fisher's approach goes beyond just crunching numbers.
Yeah.
It's about understanding the intangible qualities of a company.
Right.
The culture. Yeah. The leadership.
Right.
The ability to adapt and overcome challenges.
Absolutely.
So thinking about everything we've discussed so far, what stands out to you?
That's a great question.
Is the most valuable takeaway?
For me, it's the powerful combination of patience and thorough independent research.
Yeah.
Fisher constantly reminds us that successful investing is a marathon.
Not a sprint.
It's not a sprint. It's about finding outstanding companies with solid fundamentals and letting those investments compound over time.
It's almost like he's advocating for a Zen approach to investing.
Exactly.
Don't get caught up in the daily swings of the market.
Just focus on the long game.
Long game.
And the research aspect
is crucial.
He's not just talking about skimming a few financial statements.
Yeah.
It's about really understanding the company's culture, its competitive landscape, its management team.
Piecing together.
It's about piecing together.
A story, a narrative.
A narrative, as we were talking about earlier.
And that's where the scuttlebutt method comes in.
Right.
Gathering insights from multiple sources, connecting the dots, forming your own informed opinion.
Right.
So if someone is listening to this thinking, okay, this all sounds great in theory, but how do I actually apply this in my own investing?
Right.
What advice?
I'd say start by asking yourself, what companies or industries am I genuinely interested in?
Okay.
What products or services do I believe in and use myself?
Okay.
Then go deeper.
Okay.
Read annual reports. Listen to earnings calls.
Yeah.
Talk to people who work in those industries and see if the management team aligns with the principles that Fisher lays out.
So it's about following your curiosity, but then backing it up with serious research.
Exactly. Don't be afraid to think differently from the crowd.
Okay.
If everyone is chasing the same hot stock, it might be time to step back and look for opportunities that others are missing.
That's how Fisher found his uncommon profits.
That's how he did it.
That's fantastic advice.
Thank you.
It's about being curious, being skeptical, and thinking for yourself.
Yeah.
And don't get discouraged if it takes time to find
It takes time.
those truly outstanding companies.
Absolutely remember what Fisher said.
What's that?
The stock market is filled with individuals who know the price of everything but the value of nothing.
That's a great quote.
It is.
It's about looking beyond the surface, beyond the hype, understanding the true worth.
The true worth
of a company. Now, before we move on, let's revisit those 4 dimensions of a conservative investment for a moment. It's a lot to consider. Products, management, competitive advantage, investor perception. Which of those dimensions?
It's hard to choose just one because they're all interconnected. But I'd say the management team is often the most telling. You can have a fantastic product, a seemingly unbeatable competitive advantage, but if the leadership is weak, unethical, or short-sighted, it's all going to crumble eventually.
It really does go back to that fish rots from the head analogy.
It does.
So you're looking for leaders with
integrity,
vision, and a track record of success.
Exactly. And it's not just about their resumes.
Okay.
It's about their values.
Okay.
Their communication style, how they treat their employees. All those things can give you insights into the long-term health and sustainability of the business.
This has been such an eye-opening deep dive.
Yes.
Into Fisher's work.
Yes.
It's amazing how relevant his ideas are.
I agree.
Even though he was writing decades ago.
Right. And it goes to show that human nature doesn't really change.
Yeah.
The markets might change. Technology might change. But the principles of sound investing remain remarkably consistent. Have you ever been blown away?
Yeah.
By a company's products or services so impressed that you thought, wow, I wish I owned stock in this company?
Or on the flip side,
Right.
have you ever had such a bad experience that you thought,
Right.
there's no way I'd ever invest in this company?
Exactly. Those gut reactions, those visceral responses can actually be a valuable starting point for further research and analysis.
So we're tapping into our inner consumer,
Yes.
our own experiences
In the marketplace.
in the marketplace to inform our investment decisions.
Exactly.
I love that.
Yeah.
It's like we're all secret stock analysts.
We are without even realizing
We're
it.
constantly evaluating companies, forming opinions, making choices, and that real-world experience can be incredibly valuable when it comes to investing.
So before you make your next investment,
Yeah.
ask yourself, what does my inner consumer
Right.
tell me about this company? Do I love their products? Do I trust their brand? Would I recommend them to a friend?
And you can even take it a step further.
Okay.
Do a little scuttlebutt with friends or family who use the company's products or services. You might be surprised by what you learn. Fantastic advice.
I'm ready for more.
Me too. I'm still buzzing from all the insights we've uncovered.
Yeah.
So far, Fisher's ideas are just so
Thought-provoking.
thought-provoking, aren't they?
They really are. He had such a unique way of looking at investing. It's not just about numbers.
Yeah.
It's about understanding businesses as living, breathing entities with their own personalities and quirks.
Absolutely. And speaking of personalities, we've got some great questions from our listeners who are clearly as fascinated by Fisher's work as we are.
I'm excited.
So let's dive right in.
Let's do it. I'm always excited to hear how people are applying these principles in their own investing journeys.
All right. First question comes from Sarah in Seattle.
Okay.
She says,
I'm really intrigued by this scuttlebutt method.
Yeah.
But honestly, it sounds like a lot of work.
Yeah.
Do I really need to talk to all those people, or can I get enough information from just doing online research?
That's a great question, Sarah.
Yeah.
And I get why it might seem daunting.
Yeah.
The truth is, you can absolutely learn a lot from online research, company websites, annual reports, analyst reports.
Yeah.
It's all valuable information.
Yeah.
But the beauty of Scuttlebutt is that it gives you a different kind of knowledge.
You like the difference between reading a travel brochure and actually talking to someone who's lived in a particular country.
Right.
You get those firsthand insights, those personal stories that you wouldn't find
in any guidebook.
In any guidebook.
Exactly. And it's about hearing different perspectives.
Okay.
A customer might have a very different experience than a supplier or a competitor.
By talking to a range of people.
Yeah.
You start to see the company.
From multiple angles.
Multiple angles.
Like those 3D pictures that pop out when you look at them from just the right spot.
Okay, so it's about getting a multi-dimensional view of the company.
Of the company.
But do I need to like go full-on investigative journalist?
Right.
And interview dozens of people?
No, not necessarily. Even talking to a few key people can be incredibly insightful.
Okay.
And it doesn't have to be a formal interview. It could be a casual conversation with a friend who works in the industry.
Yeah.
Or even just observing how people are using a company's products.
In your everyday life.
In your daily life.
So keep your ears open.
Yes.
Be curious.
Yes.
And don't be afraid to strike up a conversation.
Exactly.
Great advice.
Thank you.
Okay, next question comes from Michael in Miami.
Okay.
He asks,
Fisher talks a lot about long-term investing, but how long is long-term? Is there a specific number of years I should be aiming for?
That's a question every investor grapples with, Michael.
Yeah.
And I think for Fisher, long-term was more of a mindset than a specific time frame.
Okay.
It was about being willing
to
hold an investment.
Yeah.
For years, even decades.
Wow.
If the company's story continues to unfold
the
way you expect.
It's like planting a tree.
Right.
You don't expect to see fruit overnight.
Exactly. You nurture it.
Yeah.
You give it time to grow. And you trust that eventually it will bear fruit.
And remember,
Fisher lived through multiple market cycles, including some pretty rough ones.
Yeah.
He saw firsthand how trying to time the market is incredibly difficult.
It's like trying to catch a falling knife.
Right.
You're more likely to get hurt than to make a profit.
So instead of trying to predict the market's every move, Fisher focused on finding great companies and letting time work its magic.
Okay, so we're not talking about day trading or trying to make a quick buck.
No.
We're talking about building a portfolio of solid companies and letting those investments compound over time.
Right.
But I think a lot of investors struggle with this idea because it requires patience.
It does, and it's not always easy. There will be times when the market dips and you'll be tempted to sell.
Yeah.
But that's where Fisher's emphasis on research comes in.
Okay.
If you've done your homework and you truly understand the company, you'll be less likely to panic when the market gets jittery.
It's about having conviction in your investments.
Right.
Knowing that you're not just chasing a fad, but that you've invested in a company with real staying power.
Exactly. Now, to answer Michael's question more directly, I'd say a minimum of 3 to 5 years is a good starting point for thinking about long-term investments. But ideally, you're looking for companies you could see yourself holding for much longer than that.
All right, let's move on to our final question. Okay. This one comes from Maria in Madrid.
Right.
And it's a question that I think a lot of investors ask themselves. How do I know if I've made a mistake in my initial assessment of a company and need to sell?
That's a tough one, Maria.
Yeah.
And there's no easy answer.
Okay.
But here are a few things to consider.
Okay. I'm listening.
First, have the company's fundamentals change significantly.
Okay.
Are revenues declining? Are profit margins shrinking? Is debt increasing?
Oh.
Those are all red flags that might warrant a closer look.
So it's about monitoring those key metrics and seeing if the company's financial health
is deteriorating.
It's deteriorating. What else should we be watching out for?
Another big one is management changes.
Mm.
If a new CEO comes in and starts dismantling everything that made the company great, that's a warning sign.
Especially if that new leadership doesn't seem to share the same long-term vision that attracted you to the company.
To the company in the first place.
I mean, the first place.
And keep an eye on the competitive landscape.
Okay.
Has the company's competitive advantage eroded?
Okay.
Have new rivals emerged? Has the industry changed in a way that makes the company's products or services less relevant?
So it's about staying informed, doing your ongoing research, and making sure your original investment thesis still holds true.
Precisely. Yeah. And sometimes you just have to admit that you made a mistake.
That's okay.
Maybe you overlooked a key risk factor, or you overestimated the company's growth potential. It happens to the best of us.
The important thing is to learn from those mistakes.
Absolutely.
And move on.
Investing is a journey, and we're all constantly learning and evolving.
This has been such an incredible deep dive into Philip Fisher's
timeless wisdom.
I feel like we could talk about his ideas for hours.
Me too.
But unfortunately, our time is up.
Okay.
Any final words of wisdom for our listeners?
I would just say this.
Yeah.
Investing can seem intimidating.
Yeah.
But it doesn't have to be.
Okay.
Remember, Fisher's core principles are all about common sense, thorough research, and a long-term perspective.
So don't get caught up in the hype, the noise, the short-term fluctuations in the market.
Focus on finding great companies.
Yeah.
Do your homework. Be patient. And remember that the best investment you can make is in your own education.
Beautifully said. And on that note, we'll wrap up this episode of The Deep Dive.
Okay.
Thank you so much for joining us on this journey into the world of common stocks and uncommon profits. Until next time, happy investing.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries, which you can download as PDFs, as well as other exclusive content. It's all completely free at samfury.com.